it through an ETF or an index fund route. And that is the trend, while the numbers might kind of be dwarfed by some of the numbers that you just saw on the screen right now, but that is definitely an emerging trend that we're seeing in terms of passives and, more sectoral thematic plays really playing up in investor portfolios.
Yeah, absolutely. Which is why I'm going to come back to passives actually in a way, in a bit. And we want to talk a little more about it to understand how to evolve as investors on passives. But the first question on the big fundraisers, Kshitiz, I mean, the SBI Balanced Advantage and the ICICI Flexi Cap, these are not new categories. These are not new AMCs. So what led to the surge? I mean, Balanced Advantage is a category. Do you support it? Because there are proponents who say that, you can do your own mix. You can have fixed income funds and you can have separate equity funds. But anyway, this NFO managed to raise over 14,000 crores. So what is working in its favor? And do you subscribe to this category of funds?
So, Subi, what has happened, since this year beginning, when the markets were always, if you talk about the Nifty level, 13,500, 14,000 at Nifty levels, many of the investors and many of the banks, advisors or other advisors, they have started striving their clients that rather than you doing rebalancing and markets look little pricey, one can actually subscribe to the idea of having a balanced advantage fund, which has a flexibility of doing rebalancing at their end, depending on what AMC is launching that fund. Few work on PB, few work on momentum, few work on PE, few work on dividend yield, different models. So that category has actually done very well. Now, when you talk about the SBI NFO, which is 14,500 crore NFO, the largest NFO till date. But irrespective of that, if you take out that NFO also, there is 12,500, 13,000 crore which got collected into this category in this calendar year. So almost 27,000 crore got collected into this category. And the obvious idea was that nobody was knowing that market, is there correction is going to come now or when is the right time to put money. So they have gone for the first category, which has got the largest money, is Balanced Advantage Fund. Let the fund manager or the model do the rebalancing. Second category is a flexi cap fund, which is obviously the total correction in flexi cap is close to about 11,500 crore. But one of the major reasons for the collection was ICICI flexi cap, which did almost 10,000 crore. So again, a category where the flexibility is with the fund manager, where he can play between large cap, mid cap, or small cap space, without being fixed about how much allocation to be done.
But did you like these funds, Kshitiz? My question is very simple. So that's the rationale. But did you like these mega funds? And I mean, should one perhaps still look at, investing in them now that the NFO is over and done?
So, one thing which I like to tell you, another reason for these funds to become so big is their domestic bank support. Because, where there are bank-based AMCs where ICICI has collected 3,500 crore from their ICICI bank and SBI has collected almost 6,000 crore from SBI bank. When it comes to whether I like this fund or not, I like the category. And for sure, this category is the right category for any client who's coming in at these levels also, especially the Balanced Advantage Fund I'll go for at these levels. But yes, one can look at if there is already a proven track record of the funds which are there in the market, you can actually look at participating to that fund also. Obviously, the fund which you come out with has a flexibility to invest in next 40 to 45 days. But if you already have this category in your basket, then there is no need to add further any new fund. If you don't have, if you have a gap, and if you see that that gap can be filled with any fund which is coming in with some new idea, then one can look at this category.
Okay, fair enough. Kaustubh, now, help us understand what's happening on the passive side, because that's where the real interest is, right? Everybody's understood the importance of passives. Here is a low-cost way of, building a core part of your portfolio. But what we're now seeing is, passive funds even within sectors. Whether it is healthcare, I think there's consumption, I believe even technology for that matter. And that's where the big question is that should you rely on the wisdom of a human fund managers to pick the right stocks in a sector, or is the passive way really the way to go? Plus, there's this whole talk of factor-based investing, smart beta investing. Are you expecting more launches then on this side?
Sure, Sophie. So, to kind of address the question, firstly, I think every investor should focus and purely focus to start with on the overall allocation. And, passives are a great way of building core part of the portfolio, but I would say through the more diversified indices, your more broader indices to start with. You can choose a route of active plus passive or passive, whatever suits you. But the point is that your core holdings should be the more broad indices to start with. So, yes, there have been a fair bit of interest on the sectoral indices, and it's not too hard to guess why, because we've seen the way, the tech stocks or the healthcare stocks have really done well. since the COVID crisis. Obviously, that has led to a lot of interest in this. The only thing I would kind of advise investors is that think about if you're taking exposure, are you looking to express a view on these particular sectors? Because the biggest issue and what we've seen with investors being too late in a party, and sectoral calls like this, that you look at the past returns of a sector and get very excited and you want to come in, but large part of the returns could have probably already played out, right? And that's the challenge, that you're coming in too late and you miss the bus, and then the experience you have is completely different. So yes, passives is a great way of playing the market if you can't pick an actively managed fund, but I would tread very carefully if I didn't have the wherewithal to understand the nuances of these specific sectors, or for instance, the factors that you spoke about when I'm picking it. I would leave that, call in terms of sector allocations to a manager. A professional manager would do it by picking, an actively managed fund, and then load that up with, a broader base passive fund. If I want to take exposure to a sector call, I would still limit that to a much smaller proportion, 5%, with the expectation that, hey, look, the market will go through a cycle. I might be late in the cycle, but if I want to express a view, I'll probably hold for a slightly longer period of time. That's the way I would play this space.
Okay, got that. We have to take a break. We'll still talk more about passives and also this whole concept of smart beta investing. Some funds are already coming through on the horizon on this. What else lies ahead, and should you invest in them? We'll continue the conversation after the break.